G'day taxpayers. The capital expenditure numbers, the really important part of the economy that tends not to get a lot of coverage, partly because there's only one quarterly release on the data, unlike things like housing where there's a myriad of releases on prices, activity, turnover, auction rates and retail spending, consumer sentiment. All that stuff gets plenty of coverage, but the critical part of the economy in terms of sustaining productivity increases, in terms of getting the economy moving again, is business investment. Now, with that preamble, what happened? Business investment was basically flat in the March quarter. It actually fell 0.1%. It's actually down 0.5% on where it was a year ago, so that's not really all that great. So when we need businesses to be investing in machinery, equipment, buildings and structures to get the economy growing at a more rapid pace and also contributing to growth in and of itself, we're getting nothing from private Capex, so that's disappointing. The other element of the number is not just what happened in the March quarter. They've actually got an expectations number. The Bureau of Statistics asked businesses, how much do you reckon you're going to be investing in the year ahead? And that's usually a pretty good guide to business sentiment and what they're thinking in terms of whether they need to ramp up their Capex. And there the numbers are really disappointing too. So for financial year 25-26, the one that starts, in about a month's time, expected Capex is only up 0.7% on the estimate of a year ago. Non-mining Capex, because mining can be choppy and volatile and lumpy, is actually down a smidge. And that is in nominal terms. So depending what you want to use for a deflator for the rate of inflation on business investment, we could be having a decline in Capex. Not only in the current financial year, but in the next financial year as well. And that's really disappointing news. And the reasons probably linked to the global slowdown, the weakness in China, the Trump tariffs, all this sort of stuff are starting to impact on business Capex expectations. And of course, interest rates. The domestic economy is pretty soggy. The level of interest rates up until very recently, was very tight. Monetary policy was extremely tight, and it still is tight, even with those two piddling rate cuts that have been delivered by the RBA. So as the RBA sit down and mull over the economy and they look at the Capex side of the economy, it's just another indicator. If we need it anymore, the RBA is well behind where it needs to be in terms of monetary policy settings. It doesn't meet until the 8th of July with its next interest rate announcement, but they've got to cut, I'd say they've got to cut 50. Whether they cut 25 again and play this game of chicken with the economy, it's quite dangerous, particularly with the labour market now starting to slow. So Capex goes crapex.